Howdy folks, welcome to another beautiful day out here in West Vancouver. Today I'm joined by Dane Christensen. He's been our partner on the Innovate book and he is in insurance, so he's my insurance connection in Vancouver. And I asked him if we can get together and chat a little bit about insurance, because the one thing is I arrived here with a very clear understanding of how insurance and life insurance in particular and health insurance works in South Africa. But it's not the same over here.
It's a different breed.
Completely.
Yeah.
All right, so I've got a couple of questions that I'm going to put through to Dane, and he's going to try and help us understand exactly how things work over here. But Dane, you just sort of tell us a little bit about yourself. I mean, how long have you been in the insurance game?
Yeah, thanks, Callie. I've been doing this for about 8 years. I think the first question I usually get is how do you get into life insurance, or maybe more so why? My dad, he's been doing it for 40 some odd years, following his footsteps to an extent. I got connected with Informational, which is the sort of partner here as of recently. And what we're mainly doing is employee benefit plans and, more so what we're going to dive into today, but life insurance, disability coverage, critical illness. So yeah, I'm getting close to a decade in the business if I include a couple years at school as well. So
excellent.
Yeah.
Well, brilliant.
Yeah.
Okay, folks, so Dane, the first question that I have here is, what are the different options for life insurance?
So the easiest way to sort of explain life insurance here, and there's aspects of what you would have in South Africa that are similar to here, but I think what we see mostly, and most of the policies I sell, just being the age that I am and the people that I'm working with, a lot of them being my friends, would be term life insurance policies, which is, those are more so to cover just as it says, term, a temporary need in your life, like having a young child before they get to the age of financial, dependency, or, to cover a mortgage. These things are temporary in nature. So what we're typically selling are 10-year policies, 15-year policies, 20-year policies. On the further end, term 30 or 30-year policies. For all intents and purposes, these are rental policies.
Yeah.
You own them, yes, but they're gonna eventually expire, and when they do expire, they go up in cost a lot. Like they'll go up 5 to 10x what you were paying. So, why would someone hold on to one of these policies once they really jump to that point of, exorbitant rates and becoming unaffordable? Maybe at that time, if you've had a policy for 10 or 20 years, perhaps you have a need for more insurance. What you would do is, put your health on the line, so to speak, or put your medicals on the table, and if you're able to show that you're in good health, you get a new policy. It won't be, the amount you were paying for the previous 10 years, but it'll be much less than what that renewal is sort of going up to. So to sort of, put a bow on that point, we'll have the temporary policies to cover a temporary need, 10 years, 20 years, 30 years. Those are mainly what you'll see sold to, people who want to have some coverage for their mortgage, people who want to, people that just had a family and have more of a need, like if something happens to me today, I want to make sure I'm leaving $500,000 or maybe $2 million, tax-free, mind you, to my beneficiary so they can go through what's going to be a difficult time. So that's the one side of it. It's the one side of the coin. That's the term coverage, right? The other side is permanent coverage. Much more expensive, first off, right? Term is, you can buy a whack of term coverage for quite cheap, really. Like, I don't like the word cheap, but like it's affordable, let's put it that way. I'm 35. If I wanted to buy $1 million of coverage for the next 10 years, locked in rates for 10 years, pay monthly, I might be looking at $60, $70 a month.
Wow, that's actually not a lot.
No, it's very reasonable, right? Like that's assuming I'm in good health, and perhaps I don't even have to show, medicals. I might not even need to based on my age. But you can get a lot of whack of term insurance for very cheap. So that's why people like to have that peace of mind coverage. That's what it is.
Okay.
The flip side, as I said, is the permanent. There are two types of permanent insurance. One is whole life, which we've sort of discussed a little bit before, and I sort of know you have a little bit of an understanding of it. And then there's universal life. Difference is, this is coverage that you will ultimately have for life. So whether you pay for it monthly, you pay for it annually, whenever you, knock on wood, do pass away, whether it's tomorrow or it's age, if you make it to triple digits and you live to age 100, you're going to have some level of guaranteed tax-free payout that's going to be paid to, generally your beneficiaries, like your family, your partner, your life partner, your kids, or your estate, depending on how you want to plan that. And that money is generally used to cover the tax bill owing at death, sort of what the CRA is going to take away from your estate once they've sort of gone through the probate and things of that nature, which is sort of how it works in Canada, where your assets are going to go through the government through a process called probate, and you're actually going to owe some money based on what your assets are.
What are the rates on that? Do you know off the top of your head?
Yeah, it depends on the size of your estate. There are pretty good ways to get around actually paying certain levels of probate.
Okay.
So and these aren't like loopholes, but they're things people should know. Like if you have a proper planner sort of involved in, doing your estate planning, someone who knows what they're doing, whether it's a financial planner or a lawyer or a combination of the two. There's ways to, say with like a RRSP, a registered retirement savings plan, or a tax-free savings account. So in Canada, we have these, which are sheltered investment vehicles. You can name, what they call a contingent beneficiary to some of these policies, or primary beneficiary, where they can then roll over tax-free, which is great. So, again, that's more estate planning, but the probate piece really comes down to how you've kind of planned out your how you've done your planning, really. So it's generally, if it's below 250,000, it works out to like something like 0.5% or up to 1%. It's quite minimal. It's quite minimal, but people should have proper planning in place to make sure they're not getting hit too hard by probate. And this actually ties nicely back to life insurance. Life insurance does not form probate. It is completely secretive. It is not secretive, but it's private in the sense that it does not go through the government system with your assets, because it goes to a named beneficiary generally.
Okay, so it's the same as in South Africa. It doesn't go through your estate. It just gets paid out straight to your beneficiary. It's their money, it's done.
You're essentially, with life insurance, it's quite cut and dry, right? You cut a check, and that check is delivered to the beneficiaries of your policy, and they can do whatever they want with that money.
Okay, so just to step back into it. So you've got whole life.
Yeah.
And if I understand correctly, sorry, I've been around the block with this a couple of times with Dane, and that's why I thought it's important to start talking about it. So whole life works a little bit differently. It's not like you are paying into the policy for your whole life. You can take out a whole life policy that's going to be covering you for your whole life, but you can pay it off in a shorter period of time. So in 10 years or 20 years, you can pay up, and then the insurance keeps on. So you are insured for your whole life, but you don't have to pay a payment anymore.
That's right. Yeah. So the whole life is ultimately sort of the most. It's the priciest version of life insurance, and the reason is, and I'll sort of back up, and I'll get to that point about structure and payment structures. But whole life is, first off, if you're looking at whole life, you do have to have a need for life insurance, right? Like, it does have an investment component and a cash value component, which you can leverage and pull money out of, which I'll get to. But I would say the biggest thing, if you're looking at whole life, you still have to have a need for life insurance, right? That's generally going to mean you're going to have a family. And when does whole life make sense? It could be someone in their early 30s who has a lot of disposable income, and maybe they max out their registered retirement savings plans, their RSPs, they max out their tax-free savings account. They're doing everything they can to, tax effectively plan their income and plan their life financially. So some people will look to whole life as a, what's the third way to defer income or tax? It's RSPs, you contribute, you lower your income, less tax. Tax-free savings account, you invest. That money grows tax-free, you can pull it out, you can reinvest it, no tax associated. And with whole life, again, I mentioned that investment component, any growth within the cash value of the policy is completely tax deferred. So there is, again, your money is paid into, with whole life, you'll pay a monthly amount for, as long as you have the policy. Maybe it's 10 years, maybe it's 20, maybe you want to pay for it for life. If you pay for it for life, it'll cost less on a monthly basis than it would if you paid it off 20 years, and the same thing with 10 years. If you paid it off in 10 years, and you look cumulatively how much you've spent from 12 months times 10 years, that's 120 payment periods versus maybe paying it out until potentially age 100. You're going to be much better off if you have the financial flexibility to pay it off quicker just cause. I mean, it's going to be less expensive overall. You give the plan more time to compound, and we'll get into that a little bit too. Point is, again, with whole life, you have one big sort of bucket. Every person in Canada who owns a whole life policy, let's use Canada Life or Manulife as an example, they'll have this whole thing. They have what's called a PAR fund, so a participated account, where every premium from every policyholder is paid into there. And this is just a mishmash of things, right? It's like, this is where they pay the administrative fees to manage a portfolio. This is where they will pay out somebody if there's a death claim. This is where if someone cancels their whole life policy and they have a built-in cash value, some people might, not necessarily, but some people might, that's where they'll pay out the cash value. So money's coming in and out of this constantly. That's called the participating fund. And that money's all invested, right? So everything goes in, it comes out, but there's also an investment pool in there. It's relatively conservative. In the end, again, this is still life insurance. So we're not trying to hit home runs, right? You can do that with your TFSA, for example. Like, that's a pretty safe place to get a little riskier. Can you get riskier with life insurance? You can, but with whole life, you do not choose what you're investing in. Universal life is different, more flexibility in terms of choosing how you invest, specifically within the cash value of the policy. With whole life, it's much more, this is how it's designed. If you're buying it, this is how it's run. It's much more set it and forget it, sort of buy it, let it cook, for lack of a better idiom. It sounds funny, but that's kind of how we talk to clients about it. If you don't want to have consistent, checking your statements, seeing how the investment's doing, how it's growing, all that, then whole life, whole life's probably for you in the sense that if you don't feel like you have to constantly be checking on it, that's great. Again, you set it and forget it, and the longer you keep paying your premium, you'll see the cash value within the policy grow, and you'll see the death benefit grow as well. And this is the other aspect of whole life, right? So you have the life insurance component, you have that cash value, and the cash value will grow as you continue paying your premium. Cash value in the first 10 years is generally not too significant. After 10 years, the way most policies are structured, you'll see more cash value start building up quicker. It's a combination of just the way the payments are structured and a combination of being able to compound with the money that's going into it, so the money's growing quicker. I'll finish my thought on the cash value, then I'll move on to something else. But with cash value, and the reason people like cash value, it gives you a level of flexibility. Generally speaking, you're able to pull out money from the cash value without any tax implications. Depending on how much you've paid in monthly premiums, generally speaking, if you've put in, let's say you put in 10 grand over the course of 8 years, whatever it is, it's like roughly $400 or $500 a month, something like that. You can pull out whatever's in the cash value at that time up to what you've paid in monthly premiums. Again, if it's year 8, it might not be all the way up to what you've put into it, but if we're in year 20, you can probably pull out 10, 15 grand from it, no questions asked. The second you start going over or pulling out more than what you've paid into it in terms of the premium, then it'll be taxable. It's interest income, right? But it's nice because you can kind of get your money back if you need it. If you run into a situation that's financially a little hairy, perhaps.
So what you're saying is if I take out a whole life policy and I pay it off in 10 years, so I just schedule it over 10 years. At the end of the 10 years, I could probably take out the cash that I put in, and I still have the life part of the life cover part of the policy going.
Yes, important to note, the cash value and the death benefit are kind of one and the same. They do operate under the same guise in a sense, because eventually when the policy pays out, they don't pay the cash value. The cash value eventually is going to equal the death benefit. So the cash value is more of a tool that you can use or leverage while you're alive. But don't think that you're going to get the cash value that's built up in addition to the death benefit. That's not the case. The death benefit will eventually be equal to the cash value when you get to age 100. That's generally how policies are structured. So you will get the death benefit, but that death benefit's grown significantly from whenever you would have taken out the policy. And the reason for that is the idea of what a participating account is. Why is it considered participating? The biggest thing I didn't mention about that pool of money where all the premiums go is there's a dividend that's paid out each year to each holder of a policy. That dividend pays from that big, and to be clear, this fund of money here, the participating account, there's Canada Life is like 60 billion, like 60 billion.
Okay, yeah.
Maybe 70, like it's in that range. It's the biggest one in Canada, so it's kind of the one I like to allude to. They have the biggest one, and that makes you feel safe, right? You know your money's going into somewhere that's massive. It's conservatively run in the sense that it makes mainly 70% perhaps fixed income, 75% fixed income, 25% equity investment. So there's a dividend that's the way they justify this dividend that's paid back into your policy is kind of they consider it a return of premium because you've actually overpaid for your policy technically. Like the monthly cost, what you're paying is partially for the cost of the insurance itself. Part of it is for the administrative fees, and then part of it's kind of just like a safety net, to be honest. So that dividend pays back to you, and all of a sudden it goes into your policy. That's what also helps grow the cash value, and that dividend grows the death benefit. And that happens tax-deferred, tax-free. So cash value, again, as I mentioned earlier, grows every time you get a dividend. That's going to keep growing. And then the death benefit, perhaps you took out a policy that was, $250,000, let's say, as an example. If I die tomorrow, it's going to be $250,000. But if I die in, 15, 20 years, that policy, because of that dividend that's paid into the policy every year from the participating account, that $250,000 might grow completely tax-free to like 400,000, depending on when that is. But like if you're looking to puts that to age 80, it can easily double. And again, that's growth, 250 to 500,000. And when it eventually pays out, if it's at 500,000 at that time, that's fully tax-free. So there's no tax association with this plan whatsoever. So it is yes, it's an investment vehicle in a sense, but you never use it for that. I would never recommend someone getting a whole life policy if they didn't have a life insurance need as well. And I would also say, take care of your RRSPs and your TFSAs first. Like if you're doing this for the tax advantages, there's probably other places I would look. But if you found yourself where I've exhausted all my options in terms of finding tax-free money, and you don't think you're going to win the lottery, that's like, which is tax-free, right? Then consider this. It's expensive, but it's a really good planning tool. And in the end, the most efficient way to cover taxes owing at death is life insurance. And that's ultimately what this is. It's a life insurance with some fun tools and things that you can lose throughout the course of your life. Like, that's kind of what it is.
What's the difference between the universal life and whole life?
So, I guess whole life is more expensive. That's the thing, because it's completely managed by the insurance company. Everything about it, including the participating fund, the way the dividend's paid out, which the dividend does vary year to year depending on a number of things, but underlying economic things generally. Universal life, you can look at it a few ways. One, you can look at it like term insurance. Remember we talked about term 10, term 20, term 30. Universal life is considered permanent insurance, and what it could be on the most basic idea of permanent insurance, if you're thinking what's the most basic idea of permanent insurance, it would be term insurance to age 100. Or, if you happen to live to 105, 105. Yeah. Just cut off at 100. But they call it term to 100. But it's coverage for life, and it is the most inexpensive form of permanent insurance. If your biggest need is insurance and you want to have it for a lifetime, then you're getting that through term to 100 coverage, which for all intents and purposes is universal life. Now, universal life you can get quite flexible because you still have that cash value piece like you do with whole life. The difference is, whole life, you do not choose how the cash value part's invested, right? That's the biggest thing. That's totally managed by the insurance company. With universal life, if you want to use the cash value, you can, and you'll have about 25 to 35 different funds that you can invest in, right? So you're actually be able to choose your own investments. So some people will choose, if they want to be conservative and try to get 3%, sure. If they want to go to a more balanced portfolio and try to get 5%, if they want to be aggressive and shoot for like 7 or 8%, you can do that, and you will have those depending on how much equity you're choosing to invest in versus how many what percentage of fixed income you're investing in with whatever fund you choose. So what we'll often see is people will buy a term to 100 policy to cover what they think they need. Let's use 250,000 as an example. 250,000 of universal life versus 250,000 of whole life. I'm going to say the universal life is the whole life I should say is probably like 2.5, 3 times more.
Wow.
In that range, just because again you're getting all that other stuff with it, the possibility of growth, self-managed. So that's it, right? Like whole life can look really good if you start it early enough. Some people just don't have the money to start early enough, but for the people who are perhaps in their early 30s, even early 40s, whatever, who do have, again, disposable income and they've sort of exhausted the other avenues. Pumping money into whole life, can be quite strong. Like we see a lot of people own them corporately, like business owners we work with, they'll own them corporately, have them in a holding company, pay for it with corporate dollars, and it's not unheard of to see people putting in 100,000, 200,000 each year into whole life policies, just to create the biggest sort of tax-free payout that they can to cover taxes.
Yeah, because if I'm correct, and correct me if I'm wrong, if you do that where your corporate pays for it, even when the payment pays out or eventually, that is still not taxable, but you are also not paying tax on this at the moment because it's an expense. So it's a kind of a win-win.
Yeah, it is. Yeah, like if you own it in a corporation and you're paying for it with corporate dollars, which are, depending on your setup, are usually like paying with a 27% after-tax rate versus maybe 40 to 45, depending on how you're paying your premiums. It can add up to be a lot of money that way, right? And ultimately, there's a likelihood that it will fully pay out tax-free. The only reason that it might not is something called an adjusted cost base, and that adjusted cost base decreases and eventually goes to zero the longer you have the policy. So generally, if you have the policy 25, 30, 35 years, that kind of range, you still have it, you're still paying into it, or maybe perhaps you paid it off. That number, or the ACB, the adjusted cost base, will keep going down, where it eventually will be zero. And once it's zero, that means you're not paying any tax on it whatsoever. So it's likely that it would be paid out tax-free, but it's not a guarantee. But in the end, if you're looking at it, people like to own things corporately. It's kind of like you forget that things are coming out of your corporation. Maybe a business owner drawing a salary of 120, and then all this amount's going to the whole life. Own it corporately, and maybe you don't like to have them there, but it can pay it, right? So that's what we'll see a lot.
Yeah.
So I'll finish the point in universal life.
Go for it.
Yeah. Okay. So universal life. Go back to that. So explain the term to 100. The cheapest, most affordable sort of permanent insurance you can get will be universal life. You can invest money over and above the cost of the monthly premium. That money goes into the tax sheltered investment component. And again, depending on how you're investing it and which fund, that money that you're putting in there, 20, 25, 30 grand, you can do that. That's going to grow to fully tax deferred, which is great. Down the road, knock on wood, say 30 years pass, maybe that cash value has grown to 125,000 just by virtue of compounding and whatever mix of investments it's been in. You'll still have the 100,000 or 250,000 of universal life that you got when you took out the policy originally, but you don't have that dividend, right? The dividend is the thing that helps the benefit grow, helps the cash value grow. In this case, we have a stagnant death benefit that you signed up for that you're paying the same amount for, $250,000, and you also have that cash value because you wanted to take advantage of the tax deferred earnings. So if that person, passes away, they'll have $250,000 tax-free through the policy itself, and then in this case, they've decided to utilize the cash value aspect. They'll have, in this case, $125,000 that also pays out tax-free, which is quite unique. So you have a $375,000 tax-free death benefit, and again, that can be spent however your beneficiaries like. So more flexibility in a sense if you like to control your own investments with universal life. That's the biggest piece. But permanent insurance.
Permanent insurance.
Yeah.
So, all right, so just to kind of summarize it in totally layman's terms, your financial oaks always sound financial.
Yeah, for sure.
So you've got the term life insurance. What are the benefits and negatives of term life insurance? Term life insurance is very cheap, but if the crap hits the fan along the way and your health goes down and you need to take out life insurance again at a later stage, it's going to cost you a lot.
Yeah.
You're going to pay a crap load more. So whether you're taking out new life insurance or you said you can extend your term life, but then it goes really expensive.
It gets expensive, and if once it gets to that renewal point, it jumps 5 or 6 times. No one's going to hold on to that unless to be morbid. But like if you're terminally ill, basically, if you need that, you're going to get new coverage. You'll get new coverage. Yeah.
So basically, if I'm at the 9-year mark and they go, oh dude, you've got a heart thing, you're going to be dying in the next 2 years, then you want to hold on to that.
Exactly.
You can hold on to that because that was always the thing that I worried about. So I've got a 20-year policy.
Yeah.
I'm 53. By that time, I'm 73, and suddenly now I'm really sick.
Yeah.
And my policy expires a couple of weeks before,
Yeah.
I'm about to expire. Then what then?
Well, that's good. That's actually a very good transition in terms of why are these term policies perhaps a little more valuable than what they're made out to be, right? They don't have cash value. They don't have anything. They crash and burn, right? Like after 10 or 20 years, it's nothing. Some people don't like term insurance because they can't stand the idea of having to pay for something that they probably know isn't going to happen. So that's, some people just have a mindset where they're like, I don't care how much permanent insurance costs. I know we need insurance. I'm getting it. Some people might do a bit of term, bit of permanent, perhaps. But yeah, with term, again, you don't have any of those cool features. So with term, and using that example, let's say someone has a serious heart issue at year 9 of a 10-year policy. They're still paying the same amount regardless of whether they went through that heart issue. That can't be changed. That's set in stone. That's locked. But at 10 years, the rates are going to go up. Like if they're paying $100, maybe that's going to go up to $600, right? And it's like, oh, is this worth it? Probably not. Can I get new coverage? No, your heart issue is too serious. You're not going to get new coverage. You'll probably get declined. You can apply and try for it, but you won't. So what these term policies do, and if you're ever looking at term policies, you want to make sure they do have this feature. It's called a convertibility feature. Most do. If you're looking at the Canada Lifes, the Manulifes, the Blue Crosses, Sun Lifes, all the major carriers will have that convertibility feature. And, some carriers have better convertibility options than others. On their shelf, they might have a better product, Universal Life, Whole Life, but they all generally can do this. So, if it's year 9 and you were able to get good rates when you started out, like say you got standard rates, which is kind of what if I'm showing quotes, I'll show standard quotes, which means these are what we hope you get. Now you can get better rates potentially given things we'll probably get to later. Or you can, maybe you're a smoker and you get higher rates, or you just have high cholesterol, blood pressure, whatever, maybe you get higher rates. Let's say I locked in standard rates, which is great, and now it's year 9, and I want to go, what are my options? I still have a need for coverage. Well, you're able to convert, part or all of whatever you had in terms of the death benefit. If you had $500,000 in coverage, you could convert all that 500 if you wanted to. I mean, yeah, it's going to cost some money, but you're converting at standard rates because you got standard rates when you started, and now you have coverage for life. And this is very, very, very valuable. So
what you're saying is it's not necessarily I run it out and then it goes up 5 or 6 times. If I know just before, then I can be like, okay, hang on a second, I want to exercise my convertibility, I'm going to go into the new one, and then it's a life or a universal or whatever I convert it to.
No questions asked though. That's the beauty of it, right? The convertibility feature is huge because, things happen, right?
That changes everything.
It does.
Look, I've gone through this whole idea of setting up policies with Dane, and we've been around the block a couple of times. I made the big mistake to say that I smoke a cigarette or 2 every month. And
that's enough to be a smoker, yeah.
My premium shot through the roof.
Yeah.
So I've now stopped smoking for a year just so that I am a non-smoker, so that next time we can go again and try and get better insurance. But my whole thing was I wanted to do the whole life, and it's not about the investment part. I was just like, well, what the hell? If I'm paying 20 years for something and then it stops and and I die the year after, that seems a little bit of a waste.
Yeah.
But there is the convertibility thing. That makes a huge difference.
It really does. Like the idea, so there's a few things, right? Like the idea of just being able to lock in your insurability. You've done that by getting a term life policy. So it's, when I'm sitting down talking with my friends, I'm like, you just had a kid. I know you're smoking here and there, but let's see if you can stop for a bit and get you some coverage, because you really need coverage, because if something does go sideways, knock on wood, you might not ever be able to get coverage, right? Like once you lock in term insurance and it's not pricey, I know you have the money for it, kind of thing. It's a friend, right? So I'm talking, I'll be pretty direct with them, but lock it in, and then if something ever goes sideways, you still can guarantee coverage for the rest of your life at reasonable rates. And if you like the idea of permanent insurance, you'll probably need it at some point anyway. I mean, you can get it now at a much cheaper rate than you would 30 years from now, so lock something in. And if you want to use a number of features, so that's big. I try to really harp on that. It's just if you can't get coverage now and you're worried about it, well, you still technically have it. As long as you have the policy and you're paying for it, there's that option. So it's big. That really, really matters.
No, that's huge.
Especially once you get later in life and things, start to pop up from a health perspective more often,
Yeah, so I mean, the next question I had here was under which circumstances does which one make more sense? But I think we kind of answered that. I mean, it's like you really want to do whole life only when you have excess cash at an early stage.
Pretty fair.
And you want to actually just kind of, invest some money tax-free for the future.
Correct.
Correct. And also cover you a little bit extra, but it's not, whole life is not so much about the life insurance as about like the whole tax-free and that side.
But that's definitely, I'll add one point to that. Like for the right person who's maybe perhaps on the younger side, they don't have they might have a family, but they have a disposable income. Okay, whole life might make sense. And then, there's often like a pretty big gap from like maybe the age of like 40 to, this isn't for everyone, but like 40 to 55, 60, where people feel like maybe they don't need it. Then there eventually does come a time where people hit the age of 60, 65, maybe 70 at the upper end, where they just don't have a need for 10 years insurance anymore. And you start looking at a 10-year policy when you're 65 or 70, it's not cheap, right? You might be looking at $600,000, $1,200, whatever, depending on what you're looking at. So at that point, people often do want to look at permanent coverage when they get to the point where they no longer need term insurance. That's where the big conversation becomes. So like, I don't need 10 years, but I wouldn't mind having some permanent. That's kind of the other time. Invest, like kind of just general horizon, right? Investment horizon, family planning, all that. Following the general.
No, well, I must say that actually changes my mind quite a bit, because at the end of the day, the last time we discussed this, and at that time I spoke to a couple of other brokers as well. And my idea was like, the typical South African mindset. And, I want to get this insurance and I want to know that we cover it forever. But it is actually stupid, because at the end of the day, if you die at different times in your life, there's going to be different needs. If I die now, my kids need to go to university and that's going to cost money. So it's better to have a 10-year thing.
Correct.
10 years from now, hopefully, well, not hopefully, they better damn well be studying out of the house and looking after themselves. Then there's no need for me to actually be spending a lot of money on life insurance to cover them. I mean, they got to take care of themselves.
No, you're exactly right.
We do have a bit of a mindset coming from South Africa, though, that you want to leave something for your kids.
Right.
And oftentimes, I see it very often in South Africa, is where people, they actually take out a crap load of insurance that kind of it weighs down on them every month, because they want to try and give the next generation something, which is, I don't know. I suppose it's person to person, but that's not the right way of looking at it, I don't think.
Not really. I mean, you really do have to look at the person's situation. I mean, if it's a proper sit down and you should be asking the right questions. You got to see how much debt they have. You got to see what their kid's situation is. I didn't even really get into that, but like one of the pieces of like, how do I know how much term insurance I need, for example? I mean, that can be, it's a bit of a cop-out answer, but that can be as easy as just going to Google, typing in Sun Life Manulife insurance needs calculator. That'll give you a pretty good idea. But from my experience, and in the end, it's either, okay, this is how much they tell me I need, or this is my budget, and let's see how much insurance it gets me. Most people will say, this is my budget, let's see how much insurance it gets me. And you can go through the process of seeing what you need, but in the end,
it's what you can
how
afford.
much can you afford? So like, I never try to make it that simple, but for some people, that's the bottom line. It's like, I might need that, but I just don't have the money. So it's like, okay, done. Then let's apply for that amount and see if you get coverage, right?
It's actually very true, because I sat with an insurance broker in South Africa, and she was trying to pitch me on this, like, I don't know, 10 million or 15 million rand policies and things like that, and like, that's what your kids get. I'm like, you're making it sound like I'm buying a lotto ticket here.
Yeah.
I got to bet down all my money that I'm going to die soon, because then everybody's going to get a lot of cash.
Yeah, that's how it comes off in a way.
But that's not what it's all about. I mean, this is just a tool to plan for the people that you leave behind for their needs at the time.
That's ultimately it. I mean, that's it. You're exactly right.
All right, now the fun one, which I learned the hard way. What are the elements that have an influence on your policy cost? Now, I'll just tell you on this side, like I said earlier in the conversation. So I smoke a cigarette every now and again, especially after a few beers. I would have a cigarette, and that's it. It's like I'm not a smoker. And then I come here and I'm like, hey, I'm just going to be honest. I told the guy I smoke about 2 cigarettes a month. Now in Canada, if you smoke 1 cigarette, if you take a drag of a cigarette, you are a smoker. You are allowed to smoke up to 4 joints a week with some policies.
Yeah, that's true. Yeah.
But a cigarette is very bad.
Anything, whether it's like nicotine pouches, whether it's a vape, cigarette, all that nicotine pouches too, all that stuff, which are those are popular too. So yeah, you can definitely you can smoke some weed for sure. They in the last 5 years they've allowed to offer non-smoker rates for people who smoke weed, which they obviously should have. But everything is
it blows my mind though, because
accurate.
I've seen people do some weird shit on weed.
Yeah, that's the thing. I know. It's kind of like, okay, you're gonna take the word that's weed, yeah.
Right, so you can smoke a couple of joints and then go drive around. It's okay. You have a risk for the insurance.
Yeah, you can smoke cigars. You can smoke a cigar every couple of weeks too, which is actually okay.
Really?
Once a month, maybe once a month. Yeah, sure. Once a month for sure.
Yeah, I mean, I'm gonna smoke a cigar.
Yeah, put a little cigar fund next to it. You start spending. Yeah.
Okay, so what else is there?
Yeah. Okay. I mean that's okay. That's the main thing I would say. Like they are looking to see if you're smoking, right? If they're testing you, for it's kind of ironic because if let's say you did smoke a cigarette and you don't smoke that often, like you're not smoking a bunch and trying to go off it for 2 weeks and hoping they won't find it. You just smoked like 1 cigarette and you hadn't smoked for a month or 2 before. Probably won't be in your urine blood for more than 5 days, ironically. It's like, so I'm not saying it's not possible, but it's like that's usually what it looks like. But again, these rules are if they have seen you smoke or they know you smoked a cigarette once in the last 12 months, then that's it. In terms of what does the main things that affect life insurance costs outside of sex, age, smoker status, right? A typical application is going to go through a number of health and lifestyle questions. They want to know if you're doing some wild activities on the weekends. Stuff like that. Now that might affect the rates, but it might just be like an exclusion on the policy. So, an example: if you do a lot of deep sea scuba diving, for example, if you do downhill mountain biking, like racing, for example, if you're doing out of country, off-bound skiing, out of bounds skiing, that kind of stuff, they'll probably remove from the policy. And if you die by way of one of those things, then they'll probably won't.
Skydiving,
stuff like that. So the biggest things though really are, they're gonna, if they do medical testing, they're gonna do blood, urine, vitals. In some instances, they'll do an EKG to check your heart rate. It's elevated blood pressure, cholesterol, your weight. Like if you're outside of certain goalposts when it comes to weight, then your policy might be rated. They can rate your policy based on family history. When I say rated, let's say a standard rating is 100%. That's what you're trying to go for. They can rate a policy 125, 150, 175, depending on the severity of any of these things. For example, if you do happen to be a bit more heavy set, then that can extend out to maybe 150 or 125.
Okay, so rating pretty much means how much of the standard rate you will pay.
Standard rate times 20,
is 100, so
50,
125 is standard rate times 1.25. Okay.
Well, that's the piece. And again, if you went through a process of getting an application and it did come back as like a 150 rating, your broker should generally try to go to bat for you and fight that, or what we often do is apply for 2 carriers, right? Apply with 2 carriers. They don't underwrite the same every time. See what they come back with. Maybe one is proposing a rating of 150, the other 125. Pit them against each other. That stuff works. Like insurance companies want the business, but they try to get it. They want the rating ultimately, right? They don't want to see you get a better rating because they're paying more if you have a higher rating. That's how it is. But it's the broker's job to go to bat and try to do their best. So yeah, that's kind of the range of things they're looking at. But if it worst comes to worst, and maybe there was a really serious health issue within the last few years, they can straight up decline you and tell you to come back in 5 years and see if we can get coverage then.
Wow.
So it runs the gamut. It's standard or better, and then it can be ratings, and then all the way to decline, or it can be reconsideration in 2 years. Like maybe there's a significant I don't want to use back issue, but like some sort of injury or illness that they want to see more stability in over time. And maybe in a couple of years that sort of flushes itself out a little bit, and in a couple of years you can get a better offer. Those kind of things happen.
Okay.
Yeah.
So basically what Dane's saying is, for a lot of the things that you can't do anything about, that's fine, but give up skiing and skydiving and smoking and everything before you apply for the insurance.
They'll usually, to be clear, most of those questionnaires will say, have you in the last 2 years done the following? I had some. If I was talking to some of you sort of one-on-one, I would sort of describe to you how they underwrite and how it looks and things like that. But that's generally what it is. Since say 2 years. Yeah.
Cool.
Yeah.
Well, at least go on a diet for a month or so we can go away.
It cannot hurt. It cannot hurt. Like there's actual tip sheets we'll send out how to best prepare for your medical visit.
Really?
The nurse will come by sort of at your convenience. At the cost of the insurance company, they'll collect their fluids, and there are ways to better prepare for that, right? You don't want it to be a stressful day if your kids are running around going crazy. Like that's not the best day, probably.
Yeah.
You might have a little bit of elevated.
Don't want to spend the night before drinking 27 beers.
Like that. Oh, if you want to have the worst reading, that would be a great way to do it. Like, if you ought to pay more,
All right, cool. What should you think about when deciding on life insurance? I think we covered that one.
Yeah.
What are about some of the biggest mistakes people make when picking life insurance?
This one's this one I can talk on because I would say it's not so much people making the mistakes, but maybe being suggested the wrong product. I think that kind of goes to straight up transparency. Like a broker is going to make more money on a whole life sale just by virtue of a premium being much larger than what what typical premium will be on a term policy, right? So you really have to understand if this whole life policy makes sense for you, right? Kind of like what we talked about earlier. At what point in your life are you, and is there really a need for something like this? Have you done the other things we mentioned, like go to your RSPs, your TFSAs? There's other things you can do if you're looking at, if you have a need for insurance, get the cheap stuff first, and a bit more, it's very much situationally based, but I think trusting who you're working with is a really big one.
Yeah,
really, that's kind of what it is to me. It's like
that is a very valid point that Dana has there, because you get some very different information from very different people, and
pushing products that they might not make the most sense, but offer a big commission for that broker. That's you can question your broker, be like.
Ask the questions. It's
totally nothing wrong with doing that. Like, why this product, and make sure he understands why he's recommending it, right?
Yeah, and of course, if you start asking the questions, what about this, what about that, and he keeps on pushing you in one direction, that should be a red flag.
100%. I agree. Yeah, you're right. You're definitely right.
All right. What are some of the things that can have your policy voided if you do not declare that up front? Are there stuff like that?
They can, ultimately, if they found out that you were untruthful on your application, they can technically void / cancel it at any point. One thing they do have, which is a bit unique, is a 2-year contestability period. Now, the reason they would exercise this is just because, this person, again, who knows what the circumstances are, but maybe they considered it, I don't use the word suspect, but they just got this policy, they passed away in a pretty short period of time, within 2 years, right? So from their insurance company perspective, they might do a little more digging than they generally would with your typical insurance payout. A typical one being maybe after 5 or 10 years or 20 years, right? So in this case, they'll have a better look and perhaps do more of, there may be a bit of investigating done on their part, let's put it that way. So they're going to try to check
if this was maybe a
preconceived kind of policy and found a way to get the policy approved, even though there might have been something health-wise or other that wouldn't have allowed them to otherwise get the coverage.
Yeah.
So they'll do a bit of investigation.
And that's in the first 2 years.
First 2 years, yeah. Otherwise, though, if you lie, if they found out you were a smoker at the time you applied for coverage and you got approved, like you maybe didn't do medicals, and so they had no idea if you actually were a smoker, you said you were, and then they found that out later on, perhaps through your doctor, because they have the ability to read your doctor's files, maybe that came to light after the fact, they could hypothetically null your policy. Yeah. They could.
Although that would be a very hard one.
Like it would be hard. If that's rare.
If the doctor has a note that says you're a smoker before,
yes, it's
the
It would
amount
have
of
to
things
be
that needs
tough.
to align up for that would be
It's tough. It's really tough. Honestly, like really, in the end, 99 point, like this is a real stat, 99.5% of policies pay out. Like they do pay out. These are pretty cut and dry. If you have the coverage, you're approved, you've been truthful, there's nothing to worry about, then you're going to get paid out.
Yeah.
Very, very rare cases of like you're doing something highly illegal or if it's an act of war. Like those are the only two things really where they won't pay out.
Act of war.
Act of war is considered
excluded.
an excluded policy. Yeah.
All right, so if you go and wow.
Yeah, I'm sure we can think of some examples now given everything happening. But yeah, there's like that's part of it. The other one, which is a little odd, and I still don't exactly know why it exists, is a suicide clause. So if you, I've actually heard a story from a broker where this did happen, but if you get approved on a policy, your policy is placed, you're actually legally allowed. You can commit suicide after 2 years, and you will receive the payout, but not within 2 years. So I don't know how relevant that is, but that's a rule.
It's very similar in South Africa.
Okay,
We also
okay.
have a 2-year suicide exclusion, but after 2 years, suicide is
Exactly, 2 years suicide. Yeah.
All right, so do you have a responsibility to report any changes in your status to the insurance company? Say you were a non-smoker and you decide to take up smoking.
Nope, that's the nice part. Once you could just start smoking out the second you get approved. Really, I mean, there's nothing they can do. Once you get the policy and you weren't smoking at the time of the application process and you're being truthful about everything there, and then you get it. You can take up whatever you want, really.
Wow.
You honestly can. Like let's say you did want to take up skydiving or some sort of fun little weekend activity, and that again wasn't documented or perhaps something you just never did before. Then if you were to pass away by one of these, fun weekend activities, it should pay out. If it's not excluded on the policy, it should be fine.
Okay, so in other words, the moment that policy is signed and issued, when it's done, whatever happens after that is irrelevant.
Pretty ironclad. Yeah. Basically. Yeah, unless they found you lied somehow, which is not an easy thing to do, I'm sure. But that's it. You're pretty solid with these policies, and you're usually good to go once it's locked in. So.
All right. So a couple of other things, like in South Africa, we have policies for dread disease. It's something that we generally take out at the same time as a life insurance policy, and the concept for that is if you get diagnosed with cancer or you have a heart attack or something, your life's going to change, and they give you a bunch of cash so that you can take care of that.
Yeah, there's versions of this. Like there's kind of 3 separate products. There's life insurance, obviously. There's disability insurance. There's critical illness insurance. Critical illness is probably unique.
Critical illness, I think,
kind
is
of
very
similar.
much the dread disease.
Yeah, very similar. Like critical illness actually doesn't exist in the States. It's a Canadian-based plan that's only been around for like 25, 30 years maybe. Longer than I've been in the game, so I don't know exactly when, but so some life insurance policies, specifically ones with cash value, more likely to be whole life, those ones actually do have some sort of clause. It depends on the carrier, so they do vary, but they do have a clause where if you were to consider totally or catastrophically disabled, potentially paraplegic, for example, they're often able to pay out the cash value to you. So that's one version of that. But that's still a life insurance product in the end. It's just a poor scenario of circumstances or bad scenario of circumstances that would lead to that maybe happening. I think the products here that would be better mentioning would be, if dread disease would be critical illness. So the critical illness platform in Canada is, many major carriers offer it. What it is a living benefit, right? Life insurance, death benefit pays out to beneficiaries. You're buying life insurance on the behalf of someone else. Critical illness you're buying as a living benefit to pay out to you, like me, the insured individual, if I was to be diagnosed with generally one of 25 to 27 illnesses. That varies a little bit on the contract, but the 75% of the claims we see, and we do see a lot of them just because we manage so many group benefit plans as well, 75% would be life-threatening cancers. The balance of 15 to 20%, leaving the 5% for some of the other ones, but heart attack, stroke, MS, Parkinson's would be the other 4 on top of life-threatening cancer. Those form about 85 to 90% of the payouts for critical illness. So again, you're paying a monthly amount like you would with life insurance, and you'll have a critical illness benefit amount. Let's say 100,000, 250,000. On the upper end, maybe 500,000. Most people would want to perhaps cover 1 year's salary if something was to go sideways from a health perspective. So let's say we're just doing it for 100 as a round number. So you pay for this policy. Again, if you're diagnosed with one of those 25 to 27 illnesses, it meets the wording in the contract, so it's indeed considered critical as critical is defined. That will pay out to you generally after a 30-day survival period. And with that check, $100,000 tax-free lump sum. You can do whatever you want with the money. It's go out of country to seek treatment. It's help maintain standard of living as best you can, despite whatever you might be going through. Maybe you're still able to even work a bit, and you want to take that. Maybe you want to go on vacation. I don't know. You can do whatever you want.
It's your money.
It's your money. So that's a product we're selling more and more of, just because I think as stats come out, chance of someone getting cancer now in their lifetime is it's at 1 in 2 essentially now, if not even higher. Wow. So yeah, those stats.
Really?
Yeah. There's that's well documented now. So chance of someone getting cancer at some point in their life, it's like 1 in 2.2. So it's very close to 1 in 2. So
sure.
So yes, these critical illness policies are one we get asked about quite a bit now, and there's aspects of it that are interesting because it's not just like illness. I guess the gray area is what is life-threatening cancer versus something benign. If you're having a mole removed, is that life-threatening? Do you need a payout to help you get through that? No, that's not going to pay out. But if you start getting into the way cancers work in Canada and the medical system is stage 1 to stage 4. Stage 1 is being the most benign, to stage 4 being potentially terminal, right? I'd say generally, and this is not written in stone, but once you start talking about stage 2 to stage 3, that sort of middle ground there between the spectrum, you'll have probably a pretty good chance of getting a payout if it's somewhere in between there.
Okay.
So that's kind of how it works. And there's things like coma, things like blindness, things like loss of limbs, paraplegia, Alzheimer's, loss of independent existence, which basically means if you can't do physically 2 of the 6 daily activities of living, could also be a critical illness payment, like eating, feeding, sleeping, toileting, transferring. 2 of those 6, so you're very much disabled in a way. That could also be a critical illness payout. So it has aspects of a disability plan as well.
Okay, well that was the next question. What's the difference between the disability plan and the critical illness plan?
They can both pay out, by the way. You can see disability payout and critical illness payout, which surprises people. We do sell products to group plans and individuals where they have both. Critical illness, again, it's more specific because it's a lump sum of money, and people like the idea of just being given a lump sum tax-free injection of capital. Do whatever you want with it. Disability is different. I'd say, I wouldn't say it's harder to claim on. It depends on the quality of your product. Critical illness is a little more cut and dry in terms of the quality, because these are the illnesses. If it meets it, it'll pay out. Disability has quite a few more additional features you can add to it to make it so it's more likely to pay out. If you go with the Cadillac disability policy, there's a far better chance it's going to pay out than if you purchased, I don't know, what's the worst version of a car? You know what I mean? So that's kind of the difference. But disability, the general idea is with an individual policy that I might own personally, these policies are, again, fully portable geographically and occupationally. That's important to mention. Everything I've talked about is. So if I want one of these quality disability policies that's occupationally and geographically portable, it'll generally pay out after 90 days being unable to do the regular duties of your occupation. You can't do anything. After that point, it'll start paying a monthly salary. The monthly salary is generally non-taxable, depending on how you structure it, generally non-taxable, and the amount you receive is completely dependent on a combination of either your salary and your bonus, and perhaps dividends. So a business owner can pay themselves differently than maybe your typical employee who just wants to top off their benefits plan or something. But there's a bit more flexibility in the disability policy. But again, it's a monthly salary as needed. And some of the differences with these individual quality disability products are you can incorporate things like partial disability. So the vast majority of disabilities are people who can work maybe 2 or 3 days a week, not 5. Maybe their earnings have dropped from 100,000 a year to 50. These good quality policies have something called partial or residual disability, wherein they will pay you to make you whole as if you were earning what you were before disability or working the amount of time you were pre-disability. So that type of feature is really important, and a lot of the claims are partial in nature.
Okay, and how long does it pay you out for? Is there?
Most good policies, a quality one will potentially pay you all the way out until you're age 65. and potentially can still drag on past that if you're still disabled. So you know, if you're getting paid out for that long a period of time, like if I was, you know, say 50 and I was getting paid for 15 years of disability, now I'm 65, you know, it must have been something pretty serious, right? You're going to be, you know, in talks with doctors fairly consistently to make sure you're in fact disabled, and the insurance company wants to know this too, right?
Yeah.
They don't want to. The biggest
of
fear an insurance company has is not really a life insurance claim necessarily. It's probably a disability claim where someone gets disabled at the age of like 30, 35, might be paid out $7,500 a month or whatever the number is, tax free.
For another 30 years.
Right?
Yeah.
So those are very customizable in a sense, and you know, put it this way, disability and the application process is the hardest of the three between critical illness, life insurance, because they really go through everything with a sort of a fine-tooth comb, your financials, your health history, all those kind of things. It's a little more in depth.
Okay, and what is the cost compared to, I mean, disability, is it expensive?
It can be. So the biggest thing to look at is your risk classification, and just in layman's terms, that's what's your job and is it risky? Like, I think a good example would be someone who works on a construction site might have, you know, and is dealing with heavy metals and maybe like labor and moving things around, or being in a factory or a warehouse, for example. Those people will be considered higher risk. It's going to cost them more. They might not even be able to get the really high quality products because of the risk involved. So they might have a different product that's recommended to them that's still quality, but not quite the Tesla or, you know, the Cadillac, for example. On the flip side, you know, like anyone your typical office worker, for example, someone who, or like a doctor, a lawyer, white collar, even gray collar for lack of a better term, they'll probably have a much lower risk rating, or they'll be, in fact, they'd be considered the lowest risk rating, and they'll get the most affordable rates possible. So really, the occupation, how long you've been there, your work history, all those things factor in. Like, they do want to see that you're consistently working, you know, that you don't jump around every 6 months to somewhere new. They want to see that you're receiving a salary, because it's generally easier to insure the salary from their perspective. Those are some of the things that go into it. So
interesting.
It's age. It gets really expensive the later you look at it. That's why some people like to lock in disability policies in their mid to early 30s, you know, late early 40s kind of thing, where again, once you lock it in, that cost is the same all the way up until you're age 65 or however long you want to pay for it.
What happens if you change jobs, or you get a higher increase?
Yeah. So that's a good question. Yeah. So a quality product is actually portable. Even if you lost work, let's say you're out of work, but you've been locked in a quality plan that pays $5,000 a month non-taxable, that'll still follow you to wherever you go. And you know, if you had a claim, it should still pay out. It'll be looked at a little differently, just in the sense that, okay, well, what are they doing now? Can they still justify the full payout? But you have locked in that policy, and generally speaking, it should pay out, even if you haven't managed to find employment, perhaps. So occupational portability is pretty big. Not all policies have that. I know Manulife has that, and some others don't. But
And then the other one is, I mean, if I was an office worker, when I take out the policy and now I decide to become an Uber driver, or so in other words, I go from a low risk to a high risk occupation.
Yeah.
What does that entail? I mean, do you have to report it? Do you have to go back? Is it portable? Or?
So there's a few things there that they might look at, like what some people do, and this is your example is a little different from what I'm thinking, but like what doctors will do something called own occupation. And once they have that locked in, it's like an add-on to the policy. It's called own occupation. I'm only paid for my inability to do this job as a doctor. So they could actually go get another job if they wanted to and start earning an income. Then they could also still collect the full amount from their own occupation sort of plan. So there are variations of that you will see, but I would say it more so comes down to what is your situation like at time of claim, and how flexible they're going to be with your policy. But a lot of these policies are really solid, but if your earnings have gone down significantly, then the difficulty might be collecting on the full amount that perhaps you had more coverage previously. Now, this isn't this is sort of a case-by-case thing. It's not that consistent with these type of disability policies, but having the portability is big, because
it's important.
You can't maintain that coverage, and if something goes sideways, then you still have that policy that's followed you around. And then the other point you had made, like, what if my income, say I'm with the same job, my income increases. So So what we often like to do is, okay, let's lock you in at like a $4,000 or $5,000 benefit now. That might insure you for equivalent to like 100 to 110,000 annual salary. It's usually what it sort of equals out to. But let's say in a few years from now I'm making 200. Now what? Well, when we set up this policy, we added something called a future income option. And what it allows you to do is, without medical evidence, without putting any medical evidence on the table, you can bump up your income or the disability payout from, let's say, $5,000 to $7,500. And you'll pay the difference between the cost of the 5 to get the 75 on a monthly basis, but we're not asking you any health questions. And if you can show us that you indeed did increase, show us financially that you increase your earnings, then yeah, we'll bump this up for you. So you get that option of exercising the future income add-on. So hypothetically, if you didn't have that future income option added to the plan as they call it a rider, then you have to reapply for more coverage, and who knows what your health is at that time and what it's going to cost you. So that's
brilliant.
A big piece. Yeah.
Excellent.
Yeah.
I think that covers almost everything, Dane. There's one other thing. When you go across to the US, do you need to take out additional health insurance? Because, we all hear how expensive crap is in the US. If something happens to you there, you don't want to go to the hospital.
Yes. You want good travel coverage when you go to the US. That's the key right there. So, especially if you're watching this and you're new to the country or you're thinking about coming over here, whatever your situation, but bottom line, you don't maybe have any sort of coverage as far as you're concerned, like travel coverage. The first thing you want to do is within 60 days, you'll have your medical service plan coverage, which is great. That allows you to go into hospitals and go to walk-in clinics and have that covered by the government. That's the first thing you'll want to do. If you're not going to be working with a company very soon and thus won't have, say, travel insurance coverage offered through that company, then yeah, you're going to want to make sure you go to the bank, or you can check out the Manulife website, their travel plans. Make sure you're taken care of before you do leave the country, because it works very differently in the States, where if you're hospitalized, it's just a lot more expensive because they do not have the same healthcare delivery system that we do. You pay for everything out of pocket if you don't have a plan. So we've heard some horror stories, to say the least. So you want to be taken care of. Again, medical emergency travel cover is what you want. If you want to go get your flight delayed, or lost baggage stuff, your credit card probably takes care of that, but get good quality travel coverage that might cover you up to a $5 million limit per trip. Make sure you have at least, depending on how long you're going, make sure it's going to cover that duration, 60 days, 90 days coverage, whatever it is. Those are the things you want to look out for. So again, Manulife has a good plan. You can search that, Manulife travel coverage.
Yeah, because I actually, when we went to Puerto Rico, I didn't take out travel insurance, and I broke my finger when I fell off of the scooter at the scooter accident.
Yep.
And I was about to go in there to go and have it looked at, and the doctor said to me, look, I can bring in the specialist, but we're looking at like $2,000 just for the first, $2,000 US, just for the first review, and then who knows, you're going to be in hospital for a couple of days. If they need to cut it, it could run into a couple of extra $1,000. So I suggest you just wait and go back to Canada and have it looked after there. So yeah, that was...
Yeah, for sure. If something really catastrophic happens, that's when having that coverage is really important. Like if you just found yourself in a situation where you're going to be hospitalized for weeks, if not months, that bill will be ugly when it's all said and done.
Yeah.
And that's when you need a coverage.
All right, Dave, thank you very much. If I have any more questions, I'll probably kind of corner you again, and then we can go through another one and
100%.
chat about it.
Yeah.
Guys, they do all the kinds of insurance, but they also work in benefits for companies. So if your company needs to get their shit sorted out, this is the guy to talk to.
Yeah, we got all the options, do a lot of that. We probably run 700 plans. We work with self-employed individuals and setting up with their own plans as well. We got some good options there, and anything from 1 to 250 employees. We do all that kind of stuff, and of course all the individual insurance, life insurance, critical illness, disability. That's kind of our bread and butter here at Informal Financial. Yeah.
Excellent. Thanks, Dane.
Thank you.
Cheers.